A loan is a financial transaction where one party, and usually a financial institution, provides money for property to another party with the agreement that the borrower will repay the loan amount with the interest over a set period of time. Loans are typically used for large expenses such as buying a house or a car, starting a business, or paying for education. The terms of a loan may vary depending on the lender, the borrower's creditworthiness, and the purpose of the loan. Loans have been a part of human society for thousands of years. In ancient civilizations like Mesopotamia, Egypt, and Greece, loans were commonly used as a means of exchange and to finance business ventures. In medieval Europe, loans were often made by wealthy merchants or nobles to finance wars, roads, and other large-scale projects. Interest rates on loans were often exorbitant, leading the rise of the ancillary laws that regulated lending practices. In modern times, loans have become a major part of the global economy. Banks and other financial institutions provide loans for a wide range of purposes, including personal loans, mortgage loans, and business loans. The development of credit scoring system has made it easier for lenders to assess the credit worthiness of borrowers and determine the terms of a loan. The loans are essential tool for individual and business to finance their goals and achieve their dreams. People take loans for a variety of reasons, including number one, buy a home. A mortgage loan is one of the most common types of loan that people take. It allows individuals to purchase a home, which is often the largest expenses that most people will have in their lifetime. Number two, paying for education. Students' loans are taken by individuals who want to pursue higher education but may not have the funds to pay for it upfront. Starting or expanding a business loans are taken by entrepreneurs to start a new business or expand an existing one. Number four, paying for medical expenses. Medical emergencies can be expensive, and people may take personal loans to cover the cost of medical treatment. Number five, consolidating debt. People may take out a loan to pay off their existing debts and consolidate them into a single monthly payment. Overall, loans provide individual and business with financial flexibility to achieve their goals and manage their expenses. However, it is important to remember that loans come with interest and repayment terms, which should be carefully considered before taking out a loan. Interest is the additional amount of money that a borrower must pay on top of the original loan amount. The interest rate is usually expressed as a percentage of the loan amount, and it is determined by factors such as the borrower's creditworthiness, the type of loan, and prevailing market conditions. Repayment terms refer to the schedule of payment that a borrower must take to repay the loan. The repayment terms may include the length of the loan period, the frequency of the payment, and the amount of each payment. Some loans may have fixed repayment terms, while others may have variable repayment terms that change over the time. For example, a borrower who takes out a 5-year personal loan of 10,000 US dollar with an interest rate of 7%, will have to pay back the original loan amount plus interest over the course of 5 years. Repayment terms may include monthly payments of 197 US dollar, which is the amount required to pay off the loan in full by the end of the loan term. It is important to borrowers to carefully review the interest and repayment terms a loan before accepting the loan offer to ensure that they understand the total cost of the loan, can afford to make the required payments. Banks benefit from providing loans in several ways. Number one, interest income. Banks earn interest income from the loans they provide. The interest rate charged on the loan is higher than the rate the bank pays on deposits, and the difference is the bank profit. Number two, fees. Banks may charge fees for loan organization processing or repayment. These fees provide additional revenue for the bank. Diversification of assets. Loan provide bank with a diversified portfolio of assets, which can help reduce risk. Customer retention. Providing loan can help banks retain customers and build long-term relationships. Customers who have loans with a bank are more likely to use other products and services offered by the bank, such as saving accounts, credit cards, or investment accounts. Number 5, compliance with regulations. Banks are required by regulations to meet certain lending requirements, such as making loans to low-income or minority borrowers. By providing loans, banks can meet these requirements and avoid penalties for fines. Overall, the provision of loans is a key source of revenue and a core function of banks. By providing loans, banks can earn interest income, generate fees, diversify their assets, retain customers, and comply with regulatory requirements.